Hi, welcome to the World Financial Symposium's Market Spotlight webcast series. Today's focus is on M&A for health tech companies. I'm Justine Rong with WFS, an international organization dedicated to educating technology leaders through webcasts like these and live conferences. Join us at our next Growth and Exit Strategies conference on June 18 in Toronto. Learn more at www.wfs.com. I would like to now introduce today's moderator, Nat Burgess, President of the Quorum Group.
Thank you, Justine. I'm excited about today's presentation. Let me just cover the agenda quickly. First, we'll talk about what makes health IT so compelling for investors and for acquirers. What are the funding and M&A trends that you should know about when you form your own strategy as the CEO of a health tech company? Which companies are getting acquired and why? We'll also hear from an expert on funding and funding trends and from a recent client who was acquired by Marlin Equity, went through a very exciting transaction, and we'll share his war stories from the trenches. And then finally, we'll close with pro tips on how to put together a successful M&A deal in today's market. My name is Nat Burgess. I'm president of the Quorum Group. I've been involved in tech M&A for 30 years. And as a firm, Quorum has closed close to $500 million in health tech transactions over the last 2 decades. And we've covered a lot of different ground within the segment. It's obviously a huge segment. Those include EHR, EMR, practice management, imaging, staffing, long-term health care, medical device management, clinical trial analytics, and others. So over the years, we've covered a lot of ground in the space. And as we start out here in 2015, we're seeing some clear trends on areas that are consolidating, companies that are getting acquired, and we want to give you our view on how to take advantage of those trends. Health tech is dynamic, and there's so much opportunity, but there are also a lot of traps. I want to focus in on 2 of the dynamics that make this market so compelling. The first is technological change. We're seeing data, we're seeing applications, and we're seeing users interacting and moving to the cloud. And this creates a whole new layer of compliance and privacy concerns that have to be adapted to our new cloud and SaaS infrastructure. All practitioners have had to adopt meaningful use or are in the process of adopting, which gives us electronic health records, but they're only useful when we have integration and interoperability. So that's opened up a huge area of investment and consolidation measured in the billions of dollars. Population health is another important trend where we're trying to treat populations and improve their health overall. But that only works when you have analytics that can give you feedback and data on how you're doing in that regard. And so we're seeing some very cool companies emerging in the analytics sector covering that problem. Number 4, the Congress of health care, or the people who control the purse strings are ultimately the insurance companies. And so we have all sorts of rigor now in reviewing reimbursement requests, being ICD-9 compliant and soon ICD-10 compliant. And so we're seeing great strides forward and opportunity in compliance and collection, ensuring reimbursement for practitioners. As in every other market, we're seeing the growth of exchanges. Exchanges basically leverage the web to give people choices to match buyers and sellers. This allows comparison shopping for elective medical treatment and sometimes for non-elective medical treatment, or to find the best practitioner. And there's explosive growth there, some interesting startups starting to get traction. And then once we get down to the level of patient care and diagnostics, we're seeing technology opening new doors for treatment and for diagnostics. We've identified genetic markers that inform healthcare and treatment. And this gives us new avenues for prescribing drugs that are specific to specific cases, and also predicting outcomes. Telemedicine is bringing data from the patient back to the practitioner or the electronic chart or doctor. And again, this creates round-the-clock surveillance of patients. It opens up new doors for rapid diagnostics and also just for bringing more data to bear. And on the topic of more data, we're seeing the growth of wearables, and we're starting to see wearables applied to diagnostics, and we're starting to see patients like myself wearing Fitbits and coming into the doctor with a data cloud that can help the doctor figure out what's going on. And actually, Yasmin Kodamarati later today will profile a deal that Facebook did, specifically trying to get a piece of that market. Along with technology change, we're seeing societal change. We're getting older, and our aging population spends more time grappling with health issues, taking more ownership of health issues, spending more money, driving opportunity. And these patients have more resources, such as Google, to become informed on conditions, to diagnose themselves. And we're also seeing the rise of chronic diseases. Ironically, healthcare is improving, but we're living longer, and in many cases, we're not living a more healthy lifestyle with the Western diet, with sedentary lifestyles. That's increasing chronic diseases, and the treatment for those is frankly getting more expensive and more complex. It's becoming harder to be profitable as a hospital or a practitioner. And so the hospitals are merging, the small practitioners are being acquired, and what we end up with is sort of a big box store approach to healthcare where everything's streamlined, and in many cases, the family doctor or the primary care doctor is taken out of the equation. So if you were to go ask a millennial, who's your doctor, who's your primary care doctor, 9 times out of 10, they actually don't have one. If they need something, they go straight to a specialist. So this collision of societal change and technology opportunity is driving a growth in spending and opportunities for startups. Accenture put together their forecast of digital health funding up to 2017. We see it doubling between 2014, or almost doubling between 2014 and 2017. And a lot of this growth comes from the areas we'll talk about further on in today's session around infrastructure, interoperability, health analytics, engagement, wearables, a lot of money being put to work, but as we'll see in the M&A section, also a lot of money being taken off the table. And then finally, we'd be remiss if we didn't mention the unicorns. We're seeing a rise, especially in Silicon Valley, of big companies attracting immense valuations. Uber is one that everyone's familiar with. Their valuation is now at a point where they probably can't go public, and maybe they can't be acquired either. And we're seeing some ripples of this trend in health tech, with Oscar Health raising $145 million at a $1.5 billion valuation. NadHealth recently raising another $45 million. Their total is now at $525 million, and they're talking about a $4 billion IPO. Proteus Digital raised $172 at $1.1 billion. Practice Fusion in the EHR market, $70 million at a $700 million valuation. These are eye-popping numbers, but to be fair, for our clients and for most companies that are operating in the smaller end, sort of the SMB market, these aren't terribly relevant because NadHealth and these others are reluctant to make smaller acquisitions that actually put the focus on near-term results and don't move the top-line needle on revenue. So interesting trends, but not prolific acquirers yet. So with that introduction, I'd like to hand it over to Yasmin Kodamarati, an analyst at the Quorum Group, who will walk us through some of the recent financial trends in the health tech market.
Thanks, Matt. So EBITDA multiples for public healthcare technology companies have been holding steady around 22x going into 2015, and it seems the market is consistently valuing these companies based on EBITDA as opposed to sales. It's also important to note that these are significantly higher than EBITDA multiples seen in 2012, which hovered closer to 17.5x. Looking at M&A activity for healthcare technology, total deal value for Q1 2015 is up slightly from Q1 2014, but more importantly, total deal count for Q1 2015 is the highest it has been in the past 3 years. In that time period, the top acquirers by deal count include some familiar names, and many of them are investing in certain themes. MDON, for example, has been focused on healthcare payment solutions. IMS Health has been busy shoring up its analytics capabilities, and MetaWare's recent acquisition suggests an interest in expanding their reach in the home healthcare market. And what's interesting is that their streak really started with the acquisition of one of Quorum's clients, FastTrack, in June of 2013, which nearly doubled their customer base in the home health market. So looking at deals by transaction size, sub-$10 million deals are up 76% in 2014. This trend seems to be continuing into 2015 due to the increased total deal count seen last quarter. 2014 also saw the return of deals north of $1 billion, which is a good sign. Not too much has changed in the geographic breakdown of HealthTech targets over the last 3 years. About 75% of targets are located in the United States and Canada, but in 2014 we saw Europe's share slightly increase. Looking at all HealthTech deals in 2014 compared to the previous year, categories such as mobile and analytics showed the most growth. While EHR and practice management are slowing down somewhat, important deals in this category continue to be made, such as Athena Health's acquisition of EHR solutions provider Razor Insights for $40 million earlier this year, which will expand their presence in the 50-bed and under inpatient care environment, currently accounting for 1/3 of the U.S. hospital market. In December, Swedish senior citizen mobile device manufacturer Doro acquired social alarm and personal security device maker CareTech for nearly $32 million. This allows Doro to enter the growing telehealth market and leverage their existing customer base. In the analytics space, Premier's acquisition of Theradoc from Hospira for $117 million propelled them to the top position in the clinical infection surveillance market. And Bina Technologies' acquisition by Roche for an undisclosed amount will enable Roche to expand their genomic analysis solutions portfolio. 3D technology is also of interest to buyers, as seen in 3D Systems' acquisition of Symbionics, the leading provider of 3D virtual reality surgical simulation, for $120 million last year, which expands their reach from the training room to the operating room, and their complementary global sales channels and clinical relationships should accelerate cross-platform adoption. Another deal in a similar space was Materialize's acquisition of Quorum client OrthoView for $14 million, which allowed Materialize to expand its portfolio of 3D printed health solutions. In the health insurance/payer solution space, Caperio's acquisition last year by Emdion for $115 million will accelerate their ability to provide revenue cycle management solutions. We're also seeing tech companies enter the digital health market. An example of this is Protogeo's acquisition by Facebook, which signifies their growing interest in mobile fitness and telemedicine. And Box's acquisition of MedXD from Clariso for $3.8 million shows their interest in entering the healthcare vertical, since hospitals represent the fastest growing part of the cloud storage business. MedXD's technology improves interoperability, which is a theme that will grow in importance as healthcare providers produce more and more data.
Thanks, Yasmin. It's fascinating to see all of these transactions, hundreds of them, mapping to the dynamics and the trends that we highlighted earlier in the health tech arena. And also interesting to see the acquisitions of smaller companies accelerating. We'll now hear from Katya Hancock from Startup Health. Startup Health is assisting a lot of emerging health tech companies, but also tracks data on funding trends. And I'd like you to bear in mind the M&A trend that Yasmin just highlighted as we get into Katya's presentation.
Hi, I'm Katya Hancock, the Director of Strategic Partnerships at Startup Health. Startup Health is a global platform and academy for digital health entrepreneurs. We're quite different from a typical incubator or accelerator because we are a long-term program. We focus on helping build equity value in digital health startups over a 3-year period. We're also a global program and platform. We currently have 101 startups enrolled in our academy, and they reside in over 50 cities and 9 countries. Our goal is really to help transform healthcare by building 1,000 startups over the next decade. We were founded almost 4 years ago, so we are on our way, helping to build up this awesome ecosystem. We at Startup Health have built a robust funding database called Startup Health Insights. We're tracking over $16 billion worth of deals since 2010, all of the funding in the digital health space. So today I'm going to present some of the interesting trends that we've been seeing in 2014, which was a huge breakout year for digital health funding in the startup space. Also, we'll be taking a look at what happened in Q1 of 2015. Funding in 2014 more than doubled from 2013. There were $6.5 billion worth of deals compared to $2.9 billion in 2013. We're really seeing signs that the market is maturing. Although there was more capital invested, there were actually less deals total. So 590 deals in 2013 down to 459 deals in 2014. When we take a look at digital health funding for Q1 of 2015, we're seeing that it was a very strong quarter this year, but did not surpass the huge first quarter of 2014. So there were $0.9 billion worth of funding, which was double that of Q1 2013. So let's take a look at the most active subsectors in the first quarter of this year. Big data and analytics was a big winner. Yet again, that was the most active subsector in all of 2014 as well. There have been 6 deals already this year in big data and analytics, or as of the end of Q1 2015, $202 million invested. A lot of deals in patient and consumer experience. You can see it's the third in terms of dollars invested, but the highest number of deals, 20 deals in the patient consumer experience. So very exciting stuff. And again, we're seeing a really maturing industry here in digital health. Lots of new patient-generated data, so it's not surprising that big data and analytics is an emerging sector as all of that newly available data is being analyzed and made use of. Digging into the big data and analytics sector a bit, we're looking now at how this sector performed last year. A majority of the deals that were done were in seed and Series A in big data and analytics in 2014. However, the actual capital was concentrated in mid-stage deals. Again, we're seeing a lot of startups get follow-on funding, particularly in the big data space. Some notable deals for big data: Flatiron Health, Nant Health, Apper Informatics, that's a startup health company. They do bundled payment analytics for health insurance plans, really breaking out last year for fundraising and sales. Another subsector to spotlight is population health. Only one late-stage deal in population health. So it's really an emerging space in terms of a lot of early-stage funding. Some big deals there: Evolent Health, WellTalk, DocuTap. Qualcomm Ventures was involved in this space, and as you'll see later, Qualcomm has just been doubling down and taking a lot of big bets in digital health. Navigating the healthcare system is another breakout subsector, which is not surprising considering all the changes in healthcare delivery. Patients are becoming more empowered, a lot more options, and so a lot of new solutions coming out to help them navigate the healthcare system. Oscar raised a Series A in 2014, $80 million, and I'm sure you just saw just in the past week, they raised a huge B round to over $140 million. Interesting that even since this report was published, more exciting news out of the navigating the healthcare systems subsector. The top venture investors of 2014, I already mentioned Qualcomm Ventures. They invested in 12 digital health deals last year. So that is really just a huge bet on the subsector, which is super exciting. Social Ventures coming in second with 10 deals. They've always been very, solid group of futurists. Only one investor on this list decreased their deal count from 2013 to 2014, which is Andreessen Horowitz. They went down to 6 deals from 9. All of the other leading investors made as many deals or more deals than they did in 2013. Taking a look at the top corporate venture investors last year, this is a really exciting trend that just continues to grow momentum, and that is companies that are not traditionally healthcare companies are becoming healthcare companies. So if we look at Google Ventures as an example, and of course Qualcomm Ventures leading, these organizations are really taking huge bets in healthcare. So top corporate venture investors in 2014, we see again Qualcomm, Blue Cross Blue Shield Venture Partners with 5 deals, Google Ventures, Mayo Clinic, GE Ventures, and of course we've got some other strong healthcare corporate venture arms like Cambia, JJDC, et cetera. Now the top venture investors of Q1 of this year, GE Ventures leading the charge. They have made 5 investments year to date. They've already done more deals in digital health this year than they did all of last year. So that's a quick overview and some highlights of last year and this year so far. Again, we have 101 startups enrolled in our 3-year academy now, and those companies typically come into the program at the seed stage. So because it's a 3-year program, we've now had 3 companies acquired 8 companies raised B rounds. Almost a quarter of the companies have raised A rounds, and so they are really commercializing and scaling in our 3-year program. Thanks so much.
I'd like to welcome Patrick Hall, EVP of Business Development at EMDs. Patrick has agreed to join us today after a very successful career that continues at EMDs and a very successful transaction where EMDs was acquired by Marlin and then merged into another Marlin portfolio company. And specifically, Patrick and I will be talking about how to leverage your position when you are a successful but mature company in a dynamic and changing market. So welcome, Patrick. I'd like to have you briefly introduce yourself because you have a long history and a lot of experience in this marketplace. So give us some background on yourself. Give us just a quick background also on EMDs, if you would.
Sure. My name is Patrick Hall. I'm Executive Vice President of Business Development, as Matt mentioned. And I've been in this industry for a little over 19 years now. I've been the Executive Vice President of Business Development in that particular title for about 5 years, but have worn many hats at EMDs since the original company that I was with was acquired by EMDs in its early days. The company EMDs has developed a really big reputation in the industry. We're an electronic health records and practice management software firm that was founded by a physician. You could call it somewhat of a garage operation, except that it was founded out of a medical clinic. And Dr. Wynn had a business background too. As a practicing physician, he recognized that there was some significant inefficiencies in how medicine was practiced and was also a tinkerer on the software side and wrote his own electronic health record, which is the tool that clinicians use to actually document encounters with the patients. And he took that to the next level of bringing in the business side of it, which is called practice management, for doing essentially patient billing and accounts receivable management. We built that tool out of his practice where we installed it for the first time, and that really gave us a unique perspective in that we were able to actually quite literally eat our own cooking from day one. And that became the foundation for our success, and that we built what was known as a very, very usable electronic health record for physicians. We had a fanatical focus, still do, on our clients. And I know that sounds somewhat cliche, but when you have a physician who understands the pain that technology can potentially inflict upon your customers, you tend to want to stay away from that. So for us, it was critical to have this usable software and to maintain that and to keep that close relationship with our client base to understand what's going on, what changes do they experience, what are their pain points, and to try and correct those as much as we can. And that remains part of the mantra of what the EMDs brand stands for today, in that physicians would look at the brand and they'll say, yes, that's some software that is easy to use. And it's one of the reasons why we've separated ourselves out. So for us, a customer relationship, again, not wanting to sound too cliche, it was all about the relationship for us with our clients.
And that was something that definitely impressed me working with you on this process. I remember attending a meeting and having Dr. Wynn, your founder, come into the conference room looking depressed, and he had an upset customer. Out of 9,000, you had an upset customer, and he was planning on calling him on his cell phone later in the day to make it right. And that sent an interesting message about how you run your business.
Yeah, that's right. It's hard to scale that, but there's a core group of management at EMDs and people who are truly vested in the client base, and if you can have the time, it's well worth it.
And now when you and I would go into meetings along with Dr. Wynn and your team and talk to some of these newer web-based, cloud-based EHR companies, one thing that struck me is that they were all very proud of their products, but they were all finding it much harder to grow the customer base than they ever anticipated. I think there was an anticipation of if we build a good cloud product, they'll come to us because it's cloud, whereas from a physician standpoint, they may have some other criteria. Did that surprise you as well?
Not so much. You've got to go back to your business basics. If you're meeting a need, then you're probably going to be successful. There are a lot of new players in the market that don't understand how complex our particular market is. Some have been successful, but most have not. And that's probably because they were focused more on the product than the customer.
And that really brings me to the next topic, which is around timing. When the shiny new company gets a lot of money, and a lot of companies are getting a lot of money right now from venture capital, people tend to panic and they worry that the sky is falling, and if they don't do something right away, they're going to be out of business. In your case, in the EHR market, there was a consolidation wave that really peaked in 2011 and then started to tail off. That just reflects the total number of transactions that happened in the space every year. And so that peak was actually almost 4 years behind us when you guys closed your deal. And your deal is going to be one of the big highlights in your sector this year. It was a great deal. So talk to me a little bit about that timing and the fact that, you know, in a dynamic market, maybe sometimes you're better off getting it right and waiting than rushing in with the others.
That's right. And it's probably worth for the audience understanding that we were in a way in two markets. We were in a mature, what is known as the practice management or the billing market, which has been around for a long time, and very high saturation because every medical practice needed to get their bills paid and have a system behind them. Think about it as a form of an accounting system. And then you have the clinical side of the business, which around 2000 was brand new, very low penetration. And then for a number of reasons, both business efficiencies as well as patient safety, frankly, and mostly government funding, it really accelerated through the latter part of the 2000s and then 2010 and 2011. You would see the penetration of the market go from in the low teens, it went up to, depending on who we're talking to, 70 to 80% today. So everybody saw that growth, everybody was trying to get into the market, and then of course the growth in the EHR tailed off. And now you're left with the companies that have built their reputation and their brand and are falling back on the fundamentals. And all those little new players that came into the market because they saw the dollars flying at it, it couldn't succeed, couldn't build a critical mass of client base, they fell away. So that's where you saw a lot of this happening, and you also saw a lot of market share-based acquisitions from some of the larger companies or third parties trying to do strategic acquisitions in the market come through. People are thinking now again, so now that we've got rid of the government funding, we still are left with the fundamentals of I need to run my medical practice as a business and be clinically efficient, and you're left with the players that were doing that well anyway. And it's been interesting, out of all the players that started, of all the players that have come and have gone, of the ones that are left, 90% of them are probably the same ones that were here when we started.
That's interesting. And that's something we've seen in other markets too, where that segment gets overhyped, there's too much investment, and then when the dust all settles, there's still a fundamental need for the product, and a good company that's built a loyal customer base can continue to thrive. And you never got caught up in all that hype.
That's a really good description, yes.
So Patrick, having now gone through this and having a successful outcome, was there anything about the process that surprised you?
Well, it was new to me, so it was all an interesting learning experience. Since my experience of doing this before was many years back, and it was a very small transaction that was a handshake over a table. Nothing really surprised me. The due diligence process, having two layers of that was interesting. It seemed to come again. But most of it seemed to be, I think, a well-orchestrated plan that we walked through with Quorum and being taken from A to B, here's what you should expect, and that was probably a good part of it, is understanding where this process is going to go through to the final transaction and understanding where everything stood. What did surprise me was kind of the timing towards the end. It was, we think something's going to happen, when all of a sudden it accelerated at a much faster pace than we thought, and then time goes by and suddenly you're there.
Yep. Well, thanks a lot. I appreciate your time today, and congratulations again, and we look forward to seeing you on the circuit here at HIMSS or one of the other conferences soon. Thank you, Patrick.
You're welcome, Matt. Thank you.
Really interesting to hear from Patrick. He was definitely an MVP in that deal, and the interesting thing was that whole team really stepped up. Fantastic team, great to work with, and when we laid out the roadmap over a 6-month period of what was going to happen and when and who had the different responsibilities and how we were going to orchestrate it, everyone stepped up and really played the part, did their work well, and we achieved a great outcome together. So let's now talk about how to replicate that. I'm going to go through 5 tips on achieving M&A success in today's market. You heard some of it from Patrick, but let's boil it down. The first is you really do have to run a smart process. You might get approached by a buyer that basically tells you to put the world on hold and just try and work something out with them. You will fail. You'll be at their mercy. You need other options. You need multiple buyers. Secondly, it's a huge market, and there are very highly focused players within this huge market. So unless you run a smart process and target the companies that make sense and do it efficiently and target them all at the same time, you're going to leave money on the table. And additionally, part of running a smart process is being prepared. So you heard Patrick say that it played out the way that we laid out the game plan, but that also meant we were ready every step of the way. Second, yesterday's skills may not win tomorrow's battles. You may have built a fantastic EHR and practice management solution in the premise software paradigm, but moving to cloud and moving to SaaS is tough. You'll have new challenges. Moving to an ACO model, moving to meaningful use. These are fundamental changes in the market that may not be in your wheelhouse. And so you might have a lot of value in the company, and that value may be best unlocked by an acquirer that has some of those complementary skills that can help make it happen. Number 3 is understanding your value. We're not all Nant Health, nor would we want to be. Understanding your value means really being able to articulate why you're valuable, how you would support a valuation, and being reasonable in that. I can't go into detail on the EMD's transaction, but we had buyers come in at lower levels than where we ended up, and we explained to them where the valuation should be and how we were supporting it, and it was fair, and that's what we got at the end of the day. So really leveraging the recurring revenue, the customer base, the IP, the domain expertise, and building a valuation case is critical. Number 4 is being realistic. These things don't happen overnight. They take a lot of work. We do a lot of work. Our clients do a lot of work. And when we orchestrate correctly and work together, we achieve a great outcome. But that means everyone has to go into it knowing what they're getting into. And then number 5, consider private equity. There's a perception that a private equity acquirer will fire everyone and make you all sit in smaller chairs and drink out of smaller coffee cups to save money. But we're talking about a different class of company. We're talking about private equity firms that are builders. So ironically, they can actually be less disruptive to your business than a strategic acquirer because there's less overlap, fewer redundancies, less need to let people go, and a shared vision of building a great company. Obviously, that's not true in every case, but if you find the right partner, then you'll find a partner that's building significant companies and working with you to make your company a bigger, more significant company. And that brings us full circle back to number 1, which is run a smart process and include the private equity option. So that concludes our presentation on health tech IT funding and M&A trends. Unfortunately, we have gone slightly over time, but we will address the open questions that have come in via email, and I do appreciate your attendance today. Thank you.